Aloha and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. We are here for episode number 5, how owner dependency kills exit value. Yeah, a company, business, organization that depends upon you as the founder, the CEO, the president, there's some definite problems. So if your business can't run without you, buyers won't pay a premium. They'll price your absence. We're going to use some easy numbers here. Let's say for a minute that your business is worth $1 million in exit value. Well, if you have to be there, you may lose 5, 10, 15% of the total payout based upon the need for you to be around to answer questions. It could even be more. Let's say it's 20%. So instead of you getting $1 million, you're getting 800,000. That's real money. That's every 200,000 counts, as my friend Rosamund Fraser says. Owner dependency isn't leadership. And I want to restate that. Owner dependency isn't leadership. Sometimes founders, owners, presidents will say, hey, I want everything to run through me. The downfall of that is it's concentrated risk. And risk always shows up in price, terms, and time to close. So price may be that $1 million with, hey, we're going to give you a percentage of 20% off. We're going to pay you 800,000. And then we're going to do some holdback. Well, that holdback may be another 200,000. And if things go really sideways, you may not have gotten $1 million for your business. You may have gotten 600,000, which is a discount. Right? You didn't build your business to discount it at the time of the sale. What you're going to find is buyers underwrite continuity. They want to see that things work in the business without you. And the question they're going to ask is, what breaks if the owner steps away? And if there's a whole bunch of answers, and it's sales, delivery, approvals, key relationships, deliverabilities, they will discount the company. You will end up with less money. You will end up with less retirement. Whatever you're planning on doing, you may not be able to buy the island that you want in the South Pacific. And when you take a look, owner dependency in plain English is this. When revenue, operations, or decisions require the owner's involvement, that would be you, to work correctly, and performance drops without them, there's too much owner dependency. There are definitely ways that you can work through this, but I'm going to lay out the 3 most common hidden owner dependent processes. It's relationship to your revenue. Sometimes the founder, the owner, will go out, and the only way that business happens is if they make the deal. That is relationship tiered revenue. Decision bottlenecks. Everything has to go through the owner. Everything. There's no decision band. And one of the things that you might hear in the investment world is decision band. So a manager may be able to make a certain type of decision up to $5,000. A general manager may be able to make a decision up to $50,000. A senior vice president may be able to make a decision up to $500,000. That's a decision band. They may be able to hire, they may be able to fire, they may be able to trade business lines and say, we're not doing this anymore. That is a decision, and it really should be able to be justified by that person. Sometimes what you're going to find is the owner is the hero that has to come in and save everything, and they are the fixer of last resort. And what that is a signal to is that the talent pool is not there to run the company, to run the organization, to run the business. Every decision leads to the founder, leads to the owner, leads to the president. And one of the things that you're going to find is buyers, investors are going to detect it pretty quick because they're going to ask questions. If you've never been under LOI, you've never had an investor take a look at your business, the first part is going to be the financials. And then the next part is going to be a whole bunch of questions. Now, it may be an oral interview. I've seen that. I've been a part of that. It may be a question-based interview. I have seen that. I've been a part of that. And what they're going to do is they're going to look and ask questions and say, who can sign off on what? Can this person sign off on deals? Can this person sign off on hiring? Can this person sign up on pricing? Who has access to the books? Who pays the bills? These are all going to be questions, and it's not uncommon. I will share with you, it's not uncommon for a lot of businesses for the owner to sign the checks, which is a control. I don't really think there's anything wrong with that. I think that that's a good move, because otherwise you're open for somebody to come in and take some money that doesn't belong to them. But pretty much anything else inside of the business, really somebody can take care of it. Somebody could do it. So if somebody's needed on every deal, like the owner is needed on every deal, only they can approve pricing. Clients call the company directly, and they always got to talk to the owner, and no one else knows the process. Those are like 4 major red flags. And what we get to is the valuation penalty, a lower multiple, bigger holdbacks, longer transition requirements. And a transition requirement may be 1 month, maybe 2 months, maybe 5 months, maybe 6 months. But if everything runs through you, then what's going to happen is you're going to get paid. There's going to be money that isn't paid to you, and they're going to require you to be there. The greatest thing that could ever happen for you is for you to sell the business, give the transfer on the day that the investor, private equity, business owner comes in, and say, great, I'm out of here. You don't need me anymore. That's the greatest sign that you have a running company that is done right. They might call and say, hey, we got a couple of questions. Don't get me wrong. But if you can hand over everything on day one and it's pretty much turnkey, that is a valuable business, because now extra money doesn't have to be paid for managers and consultants to come in, even for private equity. Quick break and message from your sponsor, Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Cell Framework, Scale Framework, and Drivers Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. Earnouts as a dependency tax really can hurt your exit. I mean, you're hoping for a big pile of money at the end of the day, and you're just not going to get it. So when the buyers, the investors fear performance won't hold post-close, they push risk back on you and contingency upon payments. Hey, show me and prove to me it works. That's really what they're saying. They're saying, hey, I want to know that what you're telling me is true and what you're telling me is accurate, and we're willing to pay you. We're willing to give you the money. We're just not going to give you all of it. You're going to have to wait for some of it or a chunk of it in order to make this happen. Strategic and financial buyers really avoid founder-led everything. That might not be a platform company. And if you don't know what a platform company is, let's say that you live in a city, Miami, and your company, UCO, is a really good brand, is a really good operation. And what happens is a firm, a private equity company, an investor comes in and says, we're not in this area, and we are looking for a really good company, and we're going to pay you extra. If the typical multiple is 3, we'll pay you 5, we'll pay you 6, we'll pay you 7 to get what we want, which is a platform company. And what you're going to find is when somebody's founder-led, it reduces the ability to go in and say that. It gives you less leverage. It weakens your terms. If sales are all you, buyers, investors assume a revenue drop when the deal closes. What they're going to say is, hey, you were a $3, $4, $5 million company, but you're not around anymore. We're going to say that $2 million of that rev came from you. So you're really a $3 million company. And there's ways to fix this. So it comes down to systems. You systemize the lead flow, you systemize the sales stages, the reporting, and assign account ownership above and beyond to somebody else. You may have to take somebody under your wing and show them how to do it. There might be legal documentation, NDAs, there might be ways that you can make sure that your information stays proprietary to you inside of your business. You would want to talk to an attorney about that. But if there's an approval bottleneck, it's a problem. If every decision's routed through you, the scale is limited to what you know and what you have and what can be transferred. And this may take time. For some people, it could be 6 months. For some people, it could be a year. For some people, it could be 2 years. So what you want to do is define decision rights or band rights, whatever you want to call them, pricing guardrails and escalation rules. I know of a company recently that I was consulting, and the salesperson walked away. And the salesperson was the only person that knew the SOPs, that knew the policies, that knew the procedures, that knew the conversations, the discounting. They knew everything. And when they walked, they threw their hands in the air and said, "I'm done." Why? They would have said, "We're all POW." Right? They said, "We're all done." And it left the company in a lurch because, okay, who's going to step in and who's going to pick up a mess like that? There's years of knowledge that that person had that really stopped progress. And it took 3-4 months to get everything going. And so be aware that if something happens, you're on the ski slopes, you're wakeboarding, you're, climbing a mountain. I'm trying to, you're riding a bicycle and something happens and you can't make it into the office. I mean, it makes life very difficult for the company to run. The tribal knowledge where a processes live in your head, it's not transferable. So what you're going to do is you're going to look for the workflows that drive the revenue. You're going to pick the top 3 to 5 things inside of your business and say, what are the things that I need to document? What are the top 3 to 5 groups of information, processes, lead flow? How do we make magic happen? And then what you're going to do is you're going to create a document. You're going to create a standard operating procedure. And then you're going to go through it probably 3, 4, 5 times to make sure that everything's dialed in. So from start to finish, from the inbound call, when you pick up the phone, take the email, take the text message, to the time that you turn in the paperwork and collect money. What are all those steps? There might be 15 steps. There might be 30, but they really need to be documented. When you go to sell your business, buyers and investors will pay for proof. And they're going to look at how many percentage of the deals can close without the owner, the deliverabilities without the owner, the deliverabilities without escalation, without the involvement of the head of the business. What can happen if they step away for 2 weeks, a month, 3 months? Is the company going to survive? Is everything going to get taken care of? So for you, what you're going to do this week is pick one dependency. It could be a relationship. It could be an approval. It could be a process, and redesign it and bring somebody under your wing and say, hey, we're going to have you take this over. We're going to have you know how to take care of this task. And then you're going to turn it into metrics and into KPIs. And then you're going to run a 15 or 30 no owner test and see what breaks and then fix that first. And then what you're going to do is you're going to move on to the next thing. The end goal for you is to not be owner dependent, but be owner independent so that you can walk away from the business so you can get the maximum multiple. Mahalo for listening to the Scott Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, keep building companies that command maximum multiples. Aloha.